to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. I have a fantastic guest with me today, and one I have been looking forward to having on for really some time, and one that I think you all will enjoy listening to, and I believe you're going to learn a lot. I know I'm going to learn a lot from this episode. So with that backdrop, I think you all will enjoy today's guest. And I am sure it's going to be a very engaging conversation. But first, today's episode is sponsored by award-winning Zephyr, which helps advisors, wealth managers, financial analysts, and investment professionals make more informed investment decisions. So enough from me. Let's move on to the star of the show. I am very excited to introduce Dr. Christopher Geczy. Chris is the founder, CEO, and Chief Investment Officer of Forefront Analytics. In addition to overall firm management and firm direction, Dr. Geczy oversees investment decision-making, including manager selection, portfolio construction, and tail hedge overlay management. Chris has also been a member of the finance department faculty at the Wharton School of the University of Pennsylvania since 1997. He is an academic director of the Jacobs Levy Equity Management Center for Quantitative Financial Research. That's a tongue twister there. He has a BA in economics from the University of Pennsylvania and a PhD in finance and econometrics from the Graduate School of Business at the University of Chicago, which is now, as we know, the Booth School. Welcome, Chris, and thank you so much for coming on the show. I really appreciate it. So let's start with a little bit more about yourself.
Ryan, yeah, thanks so much for having me. I've been really looking forward to having the discussion and maybe saying something interesting to readers, although to listeners, that's an empirical question. So I was born in New York, grew up in the Midwest, St. Louis, Kansas City, New Orleans, a lot of Minnesota and Illinois, and then in Massachusetts, although I've been now in Philadelphia for 26 years with my wife and family. And I guess that you'd add 4 years as an undergraduate at Penn and years of my life at Penn. Kids play, one of my son plays D1 soccer. My daughter loves horses, and I'm in love with as my family. I love new ideas. I love having an orientation toward the search for primary knowledge and the generation of knowledge, and even studying the generation of knowledge. Have been both a practitioner and, as you mentioned, an academic, and have been a longtime user of Zephyr products, as you well know, and actually have taught and you have used products by sort of literally thousands of our students at Wharton. So it's just great to be here.
Fantastic, that's awesome. I guess I didn't realize you spent some time in Minnesota. As growing up in Wisconsin, I won't hold that against you. Spending some time in Minnesota. So
yeah. Well, I can tell from the accent, it had to be one of a couple states, right?
Yeah, that or Canada. I get Canada quite a bit, but no,
it's Wisconsin. It's Wisconsin. Yeah. No, I've been on the Sparta Elroy bike trail many times. So and went to the Wisconsin Dells. So
yeah, it's funny. I was born and raised in Wisconsin, lived there 19 years, and I have never been to Wisconsin Dells. And everybody that I talk to, the first thing they say, "Oh, I've been to Wisconsin. I've been to Wisconsin Dells." Yeah, maybe it's just
go. You're definitely missing something.
Yeah, exactly. So Chris, that's fantastic. Thank you for that little bit of background there. The benefits of portfolio diversification have really come under fire recently, particularly during times of crisis. Is it time to rethink how financial professionals view asset allocation strategies due to the difficulties diversification has when everyone runs to the exits during times of crisis?
Well, it's a fascinating question. I mean, the easy answer is to say we should always be thinking about asset allocation, what it really means. There's, I guess, a school of thought, both in kind of the rigorous academic side as well as the quant side on the street and in the city, that says that they're kind of a set of permanent relationships. And then there are others who say that we don't know everything. We don't have the overarching theory of everything in finance. I mean, we don't really have, for example, great theories behind what drives momentum effects. And it's been known, just like, merger arb strategies and many other strategies have been around for a long time. And, we don't have really great rigorous theories. We have, I think, maybe hand waving theories for why those activities generate premia. And we have some hints and we have kind of empirical clues, but we don't have the overarching theory of everything in investments, and certainly asset allocation is a piece of it. It has come under fire in part because there are stretches where, for different reasons, asset allocation is quote unquote challenged. It doesn't invalidate it, just like time varying premia don't invalidate any given model. I remember when Gene Fama was talking about value versus growth, not in the most recent troubling time period, but the previous one. And this is right after I was a student of his, when someone was talking about how value underperformed growth, and he said, well, it's a risk factor. That's what it does. Right. So there's a whole series of things to talk about there, like how things move through time. And I'm not even saying they're non-stationary. They can be stationary and time moving, time varying, and that complicates our analysis of it. The other thing is that, when we say things are almost certainly, the asset allocation rules and asset allocation relationships, theories, and strategies need to be looked at all the time. It's complicated by a series of things. The distribution is not normal. It's not a huge issue in some ways, except that we know it has to do with time varying volatility. Almost certainly expected returns are time varying. Plus, there are all kinds of questions about behavior. The other thing is that even if you are in a stationary world, when vol goes up, you can expect correlations to go up. Just think about the formula for R squared, which is the proportion of variance in a given asset or your portfolio that's explained by a benchmark or the market. That is a systematic measure of risk divided by systematic plus idiosyncratic. That's literally the equation for R squared. That's a percentage. And what happens in a tough time? Well, very often systematic risk goes up. If idiosyncratic risk doesn't go up, then R squareds go up, and R squareds are just the square of the correlation between your return and whatever you're calling systematic. So just when you need the great benefit of perhaps the only free lunch in all of economics, diversification, it becomes more challenging at periods of higher vol. The final thing I would say, it's kind of a long answer, but the final thing I would say, and there's more to talk about, is that runs on liquidity are well studied. And in fact, Doug Diamond, Phil Dipvig, and Ben Bernanke just got the Nobel Prize last October for their work on essentially bank runs and the fragility of economic systems and so on. There's a very common pattern in runs on liquidity that we seem to be seeing again and again, not the least of which might be with SVB and in the banking crisis. Yeah. So those tend to be correlated, actually. And those are not outside the theory, and they're not outside of our experience. You can expect all those things to happen just as a matter of the way the economy and markets evolve.
That's fantastic. Great explanation there. I know one thing too that I feel is if really, like you say, it's not static. And one thing that we as financial professionals have to contend with now is the growing area of retail investors, right? Now, all of a sudden, these retail investors, like what we had, during the peak of the pandemic, we had YOLO investing, right? Or the fear of missing out, all this stuff that's really starting to drive markets. And, you had AMC and GameStop and all that stuff just driving markets for a good year. And, that's things that now we got to start continuing about. You always hear about alternative data sets and, these hedge funds going out and, mining data from Reddit and all these other places to try and find different signals that maybe aren't traditional in terms of creating an investment strategy and asset allocation strategy. So it's definitely an evolving space for sure.
Yeah, you can think about it's kind of like a newer, hyped up, more technical, broader, deeper version of channel checks that fundamental analysts used to do, or standing outside your local department store, counting people coming in and out, or that kind of thing. Or it's evolved to doing things like following airplanes using their transponders, or ships using their transponders, and counting crops from satellites and all of those things. It's really it's becoming more sophisticated. Although I like the fact that you mentioned FOMO in a sense, because the one of the cutting edges in wealth management, in my view, is how we're starting to bring to bear a lot more about what we know about the brain. And this is not to say that I'm going to talk about irrationality, although FOMO seems to be a natural human reaction that leads to mistakes. Humans making mistakes don't necessarily mean that markets are inefficient. It means there might be opportunities, but they have to aggregate. And my mother-in-law, let's say my mother-in-law has FOMO. She's trading against a quant trade. She's trading against Rentec or something, right? Or some quant desk. Smarter investor. She has to be able to survive to provide the alpha again and again. And most models and logic say that if she's giving up alpha, so much every day, then she won't survive for very long. But that doesn't mean that FOMO doesn't matter, especially when you think about what financial advisors face. At Wharton, in my practice, we spend a lot of time thinking about what faces financial advisors. And FOMO is this thing we don't understand that much about. It actually has been located in the brain through fMRI studies. When you are left out of something, it looks like a certain part of your brain lights up, and it's right next to the pain center in your brain. It's like where risk aversion shows up, as I understand it, next to your information processing cortex, and I think it's in the parietal cortex. Well, the next step is to try to figure out what that means and how to deal with FOMO. Is it more emotional intelligence? Is it more robustness? Is it being dispassionate? When Howard Marks, who's one of Penn's, sort of famous alumni, also Chicago's famous alumni, comes to campus, someone inevitably asks him or other people like Warren Buffett or others, what's the most important characteristic that leads to good investment outcomes? And almost every one of the speakers that we've ever heard answer that question say something like it's the ability to control yourself, or the ability to be dispassionate, or the ability to have control over whatever it is. FOMO, huge changes in risk aversion, whatever it is. The challenge, though, is linking the two concepts, right? Time varying world, including volatility, which spikes up, right? The VIX was above 90 in the pandemic. It was above 80 in the financial crisis. Coupled with your brain's reaction to it, FOMO, risk aversion, whatever it is, and then trying to control it. I don't think those have been completely linked, but we're really close to it, man. And I think that's going to impact all of what you just talked about, including the role of advisors in people's lives. They're increasingly becoming psychologists.
Yeah, you're exactly correct. It's changed from, when I started in the industry, it was, stockbrokers, right? Now it's, financial advisor has to wear so many different hats. And I'm not going to lie, during, the cryptocurrencies and Bitcoin going to the moon, I had a case of FOMO. I had no credit to my own, but I was able to say, you know what, this isn't for me. I don't really understand it. I'm not going to invest in it. But there's a lot of days I have FOMO thinking, gosh, I really probably missed out on an opportunity there. But it's just fascinating.
The tough thing with crypto is it's hard to answer the question, what is the expected return? What's the expected return of Bitcoin? And we have some models, but the models don't seem to fit very well. There are research articles that point out some of the things, like there are momentum characteristics and there's some trading characters. Doesn't mean you can't trade it, but all I say to everyone who wants to think about investing in crypto is, why are you doing it? Are you doing it not to be left out? Is it a greater fool trade? Think that one through very carefully. Every trade is two trades, right? It's getting in and getting out. And what do we see now? well, maybe people have made money, but a ton of people have lost. And so now they're looking at embedded losses and they just think of it as an out of money option. So they're basically holding on to an asset that they don't understand even why they're holding. If you do say for like Bitcoin, or crypto, what's the statistic that was published in the Review of Financial Studies? Something like 40% of Bitcoin use up until that point had been for something, less than pretty, like, money laundering, human trafficking, drug trade. Well, I mean, that drives demand, I suppose, but it's not usually what you think about when you think about your capital market expectations.
Yes.
Right.
Exactly.
So I think there are trading strategies you can do, but to your point, I think you're going to have to, even if you're in it, you're still going to have FOMO if you are someone who experiences
that. Yeah. Especially when Elon Musk is tweeting about Dogecoin, right? And all this stuff.
Was it diamond hands? Like, this is what my students would hold up during the pandemic. Talk about
Yeah.
diamond.
And every day you're having kids or students that Bitcoin is super popular for that generation, right? So I'm sure you're seeing it firsthand more so than Sam. I did, a year ago, so I did a asset allocation study, creating an efficient frontier with Bitcoin in it. And just your regular asset classes through Bitcoin over the returns over the past like 7 years. And interestingly, every portfolio along that efficient frontier consisted some bit of Bitcoin. Whether it was the most conservative was maybe, less than 0.25%, but every portfolio along that efficient frontier included some allocation to Bitcoin. I should redo that study now. Yeah.
Well, I was just going to say, the study, I bet it comes from the two sources that drive traditional, efficient frontiers, lower correlations, even if it has high variance, and then some, return above treasuries or something like that. But then the question is, where do the expected returns come from? Because if you use just historical data, you're going to get the run up, and I think you're about to say you're going to get the run down.
Exactly. So, and I did it, when you think about it, everything is good when you're on a huge bull market, right? Everything looks good. But now that we've had a correction and more volatility, I'll rerun that study and see what it shows and compare the two efficient frontiers. But with that, talking about,
by the way, it's a great way to do a tale of two cities, right? Before the crash and after crash. We actually have a whole center here that spends time sort of focusing on this, the Stevens Center for Innovation. And they study all kinds of things. So, NFTs, and there are arbitrage strategies. It's not just a matter of going long or short. But again, though, now you start getting into the area of saying, well, is it for retail investors? Are hedge funds arbing? And you mentioned my students. We have actually had students drop out of school to go, join a hedge fund or a trading operation, arbing NFTs or doing cross, crypto arbitrage strategies. But for every one of those, there's ones that had trouble too, right? And I think the
in talking about asset allocations and creating an efficient asset mix that we've discussed here, I think this is a perfect segue into talking about during times of crisis and uncertainty, it becomes more difficult to create a diversified mix with lower correlations. What are some considerations financial professionals should make when creating or trying to create an efficient asset mix?
Yeah. I mean, well, so the fundamentals are what you have to have a view of the future, unless you're using it forensically. So, when we use Style Advisor, we teach it as at first as a forensic tool, and a tool for which you can get intuition and know the investments and know the personality of investments, but also check to see if you're, have hysteresis between your ex ante plan and your ex post implementation, or your ex ante implementation and your ex post outcomes. So it comes down to fundamentals, which really are fun at their core about expected returns, expected risk, expected correlations. A lot of asset classes that are being democratized today, or approaches are being democratized today, are sort of tail heavy, like insurance strategies, or even some of the convex strategies in the form of sort of trend following strategies. They don't have kind of traditional distributions. And by the way, I wrote my doctoral dissertation on heavy tails at Chicago many years ago, so I spent a lot of time thinking about this. It has multiple effects. But by the way, you don't need to have normal distributions to have the efficient frontier. That's one of the mythologies
Okay.
of modern finance. Normality is not needed. And even David Swensen, the famous manager of the Yale Endowment until he
Yep.
unfortunately passed away, in his book Pioneering Portfolio Management, actually makes a reference saying, you need normal distributions to get efficient frontiers. It turns out not to be true. And in fact, you can even have heavy tailed distributions and still get efficient frontiers the utility theory behind it to line up. But you do want to be careful about outliers. And so if you let me give you an example of of an investment strategy that generates amazing contributions to the efficient frontier until it doesn't. Insurance. And that can be catastrophic approaches. It can be just the concept of providing liquidity where there are outliers that arise. Those especially asymmetric outliers. In other words, think about insurance. On the average day, insurance is and by the way, it may be a brilliant investment strategy in general, but just say on the average day, you're getting insurance premia because someone is paying you to insure them. And insurance doesn't pay off necessarily on the average day because you don't see the outlying events. Then you see an outlying event, and all along you've gotten some great, really low volatility cash flows, which generates high Sharpe ratios, but now you got to pay the insurance. That's the challenge with the so-called black swan event in the left tail that Nassim Taleb made so famous. His point is that people don't really understand the tails because we live in the center where the peak of the distribution is. Even if it's not normal, the average day is not the most extreme, right? We're not, the average days in the extreme day, we're not uniformly distributed. We have, even if we have heavy tails, most of the locus of probability looks more normal than, more usual than the tails. But the problem is if you run the world long enough, you do get tail issues. And so when you're developing an efficient mix, you have to, number one, think about how you're going to forecast expected returns, volatility, and correlations. You're going to need to think about the time variable of it, which is volatility, as well as the correlation influence that we talked about. And then I think one of the hardest things is to capitalize what happens when bad things happen. And that's what happened to the 60-40, right? 60-40 got its face ripped off last year. Don't know if I can say that. It's not a statistical term. But it's, and that's not unprecedented. And correlations going up is not precedented. I think people forgot that stock and bond correlations being really low is almost a privilege and not a right. But that was an outlying event. When we have seen the greatest loss of wealth in history, it's often been around inflation shocks and growth shocks that happen at the same time. So purchasing power being shocked away at the same time, growth, which is often reflected in equities, have come down. When they happen at the same time, perhaps because interest rates are expected to increase or they do increase unexpectedly, let's say that, then that's the situation where what we talked about earlier about correlations can come in and have an effect. My view of asset allocation is that you got to think about that. The other thing that these days about asset allocation and the efficient asset mix idea is getting not just down in, moving from individual investments to asset classes, but now moving from asset classes to risk classes. Or clustering classes. And what by that I mean not just thinking about allocations, but thinking about the style behind it, which obviously you spend a lot of time doing, and then what kind of risks go into that. It's been a tough, we're sitting here in 2023. It's been a tough run in the first quarter for quality, for momentum, and for value. It's an almost diametric opposite at an asset class level to what we saw last year. I think you would still, despite that, I still think you want to be diversified across styles. And that would include quality, that would include momentum. And I think when you're thinking about an efficient asset mix, you want to at least know when you start picking investments that will get you to an efficient point, what tilts, if any, you're taking on those risks. And is that optimal for you? Because of what can happen, for example, like we saw in the first quarter.
Yeah, that's fantastic. Like I said, going into this conversation, I knew I'd learn a lot, and here we are. We could continue this conversation for hours, I think. But, you mentioned the 60-40 portfolio. A lot has been made about the 60-40 portfolio being dead. particularly in 2022. But now all of a sudden, there's a revival of sorts in the 60/40. A lot of that is made up because of the bond market recovering after a terrible 2022 and the ending of the bull market. How do you feel about 60/40 portfolio? Is it dead? Should we look at it differently? Maybe, it shouldn't be 60/40, but maybe 60/30/10 with alternatives, or what's your thoughts on the 60/40 portfolio?
Yeah, so there are at least 4 reasons to pay attention to it, and I kind of have a love-hate relationship with it. If you hated it over the last 13 years, not including the most recent volatile period, but during that, ongoing decline, secular decline in bond yields, at the same time you saw, what felt like unmitigated multiples expansion in the S&P, unexpected high returns on the S&P, unexpectedly high returns on bonds, stocks and bonds both killing it unexpectedly. That was hard for many advisors to deal with because they outperformed for a long time. They outperformed their expectations. The 60/40 outperformed its history. The U.S. 60/40 outperformed international 60/40s. It was a real U.S. 60/40 period. But there are 4 reasons so you might say, well, now what about the future? Maybe we better downweight it and think about something like a 60/30/10 or something. But there are at least 4 reasons to think about it. Number one, if you run a stock bond efficient mix, typically 60/40 is either efficient or pretty close to being efficient. It's definitely on the positively sloped portion of the frontier, even as the frontier has flattened generally since the financial crisis. That's sort of when I identify it. Mm-hmm. Number one, it's efficient. Number two, it's cheap. It's easy, right? Yep. You can invest in 2 ETFs or even 1 ETF and get it, really, really cheap. Futures contracts, nearly free. The third thing is that it's related to the 4% rule, right? The famous 4% rule, the Bengen rule, that says that all you need to do is, allocate to a 60/40, withdraw 4% of your wealth, and rebalance at a reasonable frequency. And over a 30-year time period, in a real sense, you have a 95% chance of making that retirement period. Mm-hmm. I think probably that's a 4% rule. I think today probably like orange is the new black. There's really a 2.8% rule, but it's there. So easy to do. You can do it DIY, super cheap. It's efficient, and it's tied to the 4% rule. The problem is it's not risk diversified. Mm-hmm. And you've seen these arguments for a long time now. A 60/40 is really a 93.7, an 85.15, and 95.5. When you look at the risk, most of the risk, last year maybe is one exception, but most of the risk comes from the equity piece. And mm-hmm. So if you look at what it correlates with, especially at bad times, this R-squared effect that you see, where when volatility goes up, things get correlated, make the 60/40 look a lot like just, equities. It's still the case that the fixed income part tends to dampen volatility, mm-hmm. and there's some correlation benefit, but it's a pretty vanilla portfolio. Fantastic. To add to that, we live in a democratized world. You can access alternatives. You can mm-hmm. access inflation assets. A traditional 60/40 does not, in my view, work well in inflation shock time period because of the effect on yields. And because of the effects on growth. And again, that means if you're in a 60/40, you may have challenges, especially if you're, there's mark-to-market issues or you're withdrawing money from your portfolio. I think you have to be very careful about it. I believe there are better ways to invest in many circumstances in the 60/40.
Fantastic. That's a great explanation of the 60/40. Thank you so much. So we're running close to end of time. Chris, that was a fantastic conversation. Thank you again, Dr. Chris Geczy of Forefront Analytics. Last thing, it's Mother's Day weekend. I want to give a shout out to all the Mother's Day, all the mothers out there. Thank you for everything you do. Chris, anything you have to say for Mother's Day?
Yeah, mothers and mothers-in-law.
Yes.
I mention my mother-in-law a lot. She's my toughest client. Happy Mother's Day. Yeah, thanks for having me. You asked me to recount a funny story. I have a lot of funny stories. I'm going to give you the one that relates to our conversation. At Wharton, I'm lucky enough to run a series that Howard Marks endowed called the Marks series. We bring famous investors to campus.
Mhm.
And, the students here always love to know exactly what to do and how to try to learn from the famous investors. And so Stan Druckenmiller, the famous global macro manager and George Soros's #1 trader who broke the Bank of England and all of that, famous, a brilliant guy. Genius. Some student asked him, he was in the front of the room in a 350 person audience talking about his career and the trades he's made and really sharing. And the kid asked, so how do you actually do it? And he leaned back and he looked up and he felt his belly and he goes, sometimes you just have to feel it. 3 months of modern portfolio theory out the door in about 2 minutes. I think it was half tongue in cheek, but that was Stan
awesome.
Druckenmiller telling it like it is.
I'm sure you get a lot of those great stories. That's fantastic, Chris. Thank you again, Dr. Chris Geczy. I really appreciate you coming on. Maybe we can do this again and dig a little bit deeper. Thank you all for listening to this episode of the Adjusted for Risk podcast, and have a great rest of the week.